Andrew Holland, Chief Executive Officer at Avendus Alternate Strategies, joins us on the show. Hi, Andrew. Good morning and good to see you in. What are you all doing? You know, the verdict is not something that the street was expecting, but now we have that. A coalition government is what we're bracing ourselves for. How do you approach the Indian markets?
Yeah, I think we're going to probably just see how it plays out through the next few days, let the government form, let the kind of hopefully the business as usual in terms of policy start to play out. And of course, then you have the budget. So I think there's a few concerns around, those factors. What I would say is that, government spending on, defense infrastructure, renewable energy, given, all the power cuts that, we have in across the country, it's not going to stop because there's, it's an alliance rather than it's a BJP rule party. So I think the market's overplaying it in that respect for some of these growth areas. That said, some of the valuations were a bit higher, but I think everything's getting tarred with the same brush, and I think that's where the opportunity will lie now. There are obviously fears of some populist measures coming through, but given the RBI dividend to the government, they do have some flexibility around that, and I still think they'll keep the fiscal discipline there. So I think if all of those things kind of happen, then I think the market will take. We'll take that in its stride and move forward. But certainly that kind of premium the market was enjoying is probably eroded away in the short term.
All right. And how are you positioned on the Indian markets? Andrew, you're not sounding too worried. You're saying maybe the premium valuation comes off a little bit, but there won't be any stopping the policy measures that have already been taken. There'll be continuity, which is positive. How are you positioning now in the Indian markets? If you have a long, short book, if you could give us some color on that front.
Yeah, no, we're kind of dipping our toes in because obviously yesterday was a good day to do that, and today's obviously given us opportunities as well. But as I said, it's not. I don't think there's any need to kind of be aggressive in the views. I think we can take the next few days, let the market settle down, consolidate, and just let the politics play out in terms of forming the next government and thereafter. And I think, the next few weeks will give us, plenty of opportunities to get back in the market as and when we need to.
Andrew, hi. Good to be speaking with you. Interesting times we're in. So just tell us, what's the portfolio construct for you right now? I know you can't talk maybe too many individual stocks, but in general, I mean, what's the long side of long? And now after yesterday's moves and yesterday's sort of developments, what do you think is ripe for some shorts?
Yeah, it's obviously opportunistic at the moment because obviously yesterday we kind of looked at more of the defensive sectors, and if you take IT for example, you had those kind of benign job figures in the US, which means that interest rates cuts are back on the cards in the US. So these kind of sectors will play out, and of course mid caps and small caps as a whole might be the area where you'll see a little bit more pressure in the short term because, as I said, that premium has just been taken away and everything gets tarred with the same brush. So I think that's where, we're going to end up in terms of the portfolio stance at this point.
Earlier in the morning, Andrew, we were having this big debate on whether this is going to be a very different market now. Post-COVID, it's been literally a one-way move. A lot of people who've come in the last 3 years have made a fair amount of money, and the same themes have just kept doing better and better. Are we in for a different market, one of those more boring, painful, long markets where, making money isn't that easy? Because that could deter a lot of the new, younger investors, perhaps.
See, if you're taking this over the next few weeks, I kind of agree with you that there'll be those concerns. But if you're taking, the next 3 years, which you should as a minimum for equities, then these themes will continue to play. It's not as though the opportunity in the electronic manufacturing sector has gone away for India. It's still there. So, if the policies are there, to help encourage either foreign direct investment or local companies to take advantage of that, then that will continue. So, that's a long runway you have. We're still going to travel. It's not as though we're not going to travel around and enjoy our holidays. So therefore, the tourism industry, hotels, airlines are still going to do well. So I think we're trying to extrapolate and say that very short term is going to be a longer term picture. The economy will still grow at 6.5%, 7%, because a lot of the heavy capital expenditure, which has a multiplier effect on the economy, has happened, and that will continue to flow through. And of course, the government will spend money in these areas. So I think that's all the market needs is the noise, also the narrative coming from the government to say this is what we're going to do, and we're going to continue in these areas. It might be that it's led more by large caps initially than mid caps and small caps, but they will come later.
Okay, all right. So I guess one just has to keep the faith in India and ride this one out. Andrew, great talking to you. Thank you very much for being with us on the show today.